Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. The stock market is giving us a lot of chances right now, a lot of opportunities to invest in great companies. And what I want to do today is share with you guys 5 companies that I think are undervalued at the moment or fairly valued. That could potentially be a great buy right now. So I'm going to share with the 5 companies with you guys. Of course, as always, do your own research. Make sure you find out as much details as you possibly can about these companies. And do not invest in them because I said so, okay? I'm not a financial advisor. I'm just some guy here trying to share basically my journey with everybody else. But at the same time, just make sure you're always doing your own research. Before we move on, can you please, like the video, because it genuinely helps. It doesn't cost a penny. If you haven't joined us, there's about 50% of you guys are watching these videos that have not actually become part of the community. That will really help the channel. As well as that, you can also join us on the Patreon account where you get access to the Discord, where a lot of brothers and sisters are sharing actually very good basically investment strategies and things they're doing in their portfolios and so on. It kind of helps the wider community. As well as that, you can get the Sharia compliant investing ebook. You got basically private Discord, which I've already said, ETF trackers. You got the stock watch list. We also have now a daily stock watch list that you can actually see. So if there's any specific companies you want to add to that, you let me know and I'll update that. So it's kind of ongoing thing that we basically update regularly. So yeah, if you can join us, it will really help. And of course, it will help you to become part of the community, InshaAllah. Let's get started because I want to talk about these 5 companies. As usual, we're talking about the company, the market cap, the moat. The moat is important, and the reason I said that is because we want to buy companies that have a wide economic moat. That means they can protect their business from their competitors. Okay, we're looking at the price, we're looking at the dividend yield. So all these companies do pay dividends. We're looking at the payout ratio. The payout ratio is basically the portion of the net income these companies use to pay that dividend. So we want something below 61%. And if that is the case, perfect. If it's anything above 60s, 70s is really dangerous. Unless, of course, it's REITs. REITs, real estate investment trusts, are slightly different. We've got the latest increase, so the dividend increase. We've got the 5-year growth rate. We want to see these things because we want companies that can actually not only pay dividends, but increase. So we're looking for the dividend champions. We're looking for dividend aristocrats, the dividend kings and so on. And these companies take pride in that paying that dividends. And the reason is because they want to make customers the investors happy, as well as basically show that they are quality businesses that create a free cash flow that can still pay some of their net income as a dividends, buy back their own shares, reinvest in the business, pay off debt, all that kind of thing. We also want to see how long they've been paying that dividend. We need to know how much they will pay us. We need to know how safe they are, that dividend is. According to Simply Safe Dividend, we want to see the profit margins, the return on equity. We want to see return on invested capital. This helps us to understand how profitable the business is and what the company or the management is doing to help us basically to take care of their shareholders basically. Like I said, free cash flow is always one of the most important things that we're looking for. We want companies with excellent free cash flow that's growing, not just basically going down and up and down, whatever. We want a growing free cash flow that can help the company do all the things that I've just said, from the dividends, from the buybacks and all of that stuff. We want to see how the company has performed in the last 10 years. Of course, this is not going to give us basically understand what is going on in the future, what's going to happen in the future, but it gives us an idea of where the company has been. And if we could potentially, if they can do the similar sort of a thing, then maybe it's a good investment. We want to see what's happening to the basically earnings side of things for the next year and then the 5 years that follow per year. So what is the analyst expectation of basically how the company is growing to their earnings per share and so on. We want to see from Morningstar valuation how undervalued or overvalued these companies are. I use Morningstar because I think out of all the companies out there, they quite basically they've got a bit of margin of safety. Okay, they don't just overdo it when it comes to the valuations. Okay, they're doing the discounted cash flow models, taking into consideration the free cash flow the company is going to generate in the years coming and so on. And then we can still, based on this, I can still, if a company basically says, the price says, for example, is $120 per share, I will then of course make my own margin of safety and take 10% of that, and if it hits that price target, then I'll buy the company. Then we look in the fair value. Okay, so that's what we're looking for. Now let's have a look at the first company, and that is Robot Technology. This is a company that I've spoken about very long time ago. It's 54 billion market cap. It has wide economic moat. This company develops a lot of software applications for different industrial companies. $509 per share right now. They have a dividend yield of 0.5. The payout ratio is 17%. Latest increase was 10%. The 5-year growth rate is 12%. The dividend growth, basically they have been growing this dividend, increasing it every single year for 30 years. So they are dividend aristocrat. The annual payout right now is $2.73, and safety is 98%. The profit margin is 21%. The return on equity is 8%. Return on invested capital is 5%. Free cash flow right now, they have $1.4 billion. Total return in the last 10 years, we're looking at about 15%. Next year, they're expecting the earnings to grow about 9%. Then growth estimate for the next 5 years is 11%, and it's discounted right now by 9%. $560 per share is where the price should be. Now, if we look at here, you can see a year to date is up about 17%. For the 1 year, it's about 22%. For the 6 months, it's about 11%. So this company is, so in terms of PE right now, they've got about 30 multiples forward PE. Okay. And in terms of the revenue growth, you can see there was a dip in 2020 because of COVID and so on. But then they've actually moved from $4 billion to 4.8 to now 5.3, and they're expecting about 6.1 and then 6.6 in 2024. Same goes for EPS, is heading the right direction. Okay, so that's the first company. The next company we're looking at today is one that I've actually added to my portfolio not long ago, and that's Intuit. It has 144 billion market cap. It has a wide economic moat, $514 per share right now. Dividend yield is below 1%. The payout ratio 22%. Latest increase was 15%. The 5-year growth rate is 15%. The dividend streak is basically 11 years in a row. They will pay you $3.60 for every share of this company that you own. 98% safety, profit margin almost to 17%. Return on equity 14%. Return on invested capital 10%. Free cash flow right now $4.78 billion right now. Total return in the last 10 years, we're looking at about 22%. Next year, they're expecting the earnings to grow about 14%, then 14% every year after that. Is fairly valued right now according to Morningstar. 500 is where the price should be. Right now, it's about just for $514 per share. If you still haven't liked the video, please do it. Okay, it takes a lot of time and effort to put these videos together, so I would really appreciate if you can just press that like button, subscribe to the channel, and let me know if you have any questions, inshallah. As you can see, a year to basically for the 1 year is almost up 40%. A year to date is about 31%, and the last 6 months about 21%. So right now is trading higher multiples, okay, and it's because of the growth that we've just seen. A lot of people are betting on that. Now look at how beautiful this looks. Okay, this is the kind of charts that I want to see. From 2019, from $6.7 billion to expected almost $18 billion by 2025 is absolutely huge. If you look at the in 2023, when they reported July 2023, it was 14.7. So this is from almost 7 to 14, doubled in 5 years in terms of revenue. I'm not saying it's going to continue that way, but according to analysts, from 14.3 to 16 to then 18, that's quite huge. And this is one of the reasons I actually started buying a little bit of this company. Now, if we look at the EPS, is almost exactly the identical. As you can see, it's heading in the right direction as well. The third company that we want to talk about today is Hershey, another company that I've recently added to the portfolio. 38 billion market cap. It has wide economic moat. This company sells all sorts of snacks. Price right now is $188 per share. Dividend yield of almost 3%, payout ratio 45%. Latest increase was 15%. The 5-year growth rate of 9%. Dividend streak for basically 13 years. Annual payout $4.77, which is absolutely quite huge. Safety, we're looking at about 93%. So there's no issues with that dividend. Profit margin 10%. Return on equity 24%. Return on invested capital 16%. Free cash flow $1.6 billion right now in the bank. Total return of 8%. Next year, they're expecting the earnings to grow about 8%. then 9% every year after for the next 5 years. Fairly valued again, $196 per share is where the price should be. Right now is $188 per share, so it's still that within that fair value. The next company that we look at ASML, but before we do that, let's have a look a bit more information on Hershey. And as you can see here, down 18% for the 1 year. For year to date, 16, almost 17%. For the last 6 months, 31% down. So the height was $276 per share. Right now is $288 per share. It's closer to the 52-week low, which is 183. So 180, basically $3 per share is where was basically the lowest it's been so far. Now looking at the charts here, we're looking at the revenue side of things. As you can see, from $7.7 billion every single year it has increased, and they're expecting in 2023, when basically December of this, basically next month, 2 months, next month, they're expecting about $11.24 billion of revenue. Then they're expecting 11.63 for 2024. It's heading the right direction, and this is also heading the right direction, so no issues from that side of things. Okay, next one, as you've seen already, is ASML, another one that I own in the portfolio. $254 billion market cap right now. It has a wide economic moat. As you've seen, every single one of these companies has a wide economic moat right now. Price, we're looking at about $634 per share. Dividend yield of 1%, payout ratio 22%, 5.8% in terms of latest increase. 33% 5-year growth rate of 33%, which is quite high. The highest I've seen is 39, I think, and that is Broadcom. In terms of the companies that I have researched, dividend streak of 13 years, $6.11 for every share of this company that you own. Safety is 82%, so no issues there. Profit margin, look at this here, 28%. Return on equity, 80%. Return on invested capital, 46%. And they have $5.5 billion of free cash flow right now. Total return in the last 10 years, including dividends and price appreciation and everything, you could have made about 22 percent every single year for the last 10 years. Next year, they're expecting the earnings to grow about just 5%, then 23% every single year for the following 5 years. Again, this is just estimates. Anything can happen. 15% discount right now, $750 per share is where the price should be. Right now, we're looking at about $634 per share. Now looking at for the 1 year, it's almost up 29%, almost 30%. A year to date, 15%. In the last 6 months, is just down 1%. Okay, so the highest it's been is 771. The lowest it's been is 529. So right now, it's kind of in that middle range. It has a forward PE of 30 right now. Now looking at the revenue side of it, from $12.5 billion to 2022, $22.6 billion of revenue. They're expecting that to become $28.86 billion by the end of this year in December. And December 2024, they're expecting about that to be $29 billion. So it is increasing, it is heading the right direction. There's no issues with that, as well as the EPS is also heading the right direction. Especially the EPS, the actual EPS was $15.42, and they're expecting about 20.68 right now for December of this year. So we will see what happens with that. And the final company I'm going to talk about today is Thermo Fisher Scientific. This company, I think I've mentioned a few times in the last few months, they're still undervalued right now. 177 billion market cap. It has wide economic moat. Prices right now $444 per share. Dividend yield of 0.3. Payout ratio only 6%. Latest increase was 17%. 5-year growth rate of 15%. And then dividend streak of just 5 years. Annual payout $1.40. And then safety is 72% right now. Profit margin almost 14%. 14% in terms of return on equity, or 13%. Return on invested capital, looking at about 8%. Free cash flow right now, $6.5 billion of free cash flow. Total return in the last 10 years, we're looking at about 16%, almost 17% right now. Next year, they're expecting the earnings to grow about 8%, then almost 6% every year after that. 24% discounted right now. $600 per share is where the price is at right now. Now looking at Seeking Alpha, you can see here it's down for the year, it's down about 8%. For the year to date, okay, it's about 20%, and for the last 6 months, almost down about 17%. Right now, in terms of it has a forward period of 20 right now. The highest it's been so far is $609 per share. The lowest has been 415, so not far from where it is right now. Now when we look at this, okay, as you can see, this is probably why they expecting, so they had $44.92 billion of revenue in 2022. This year they're expecting 42. So there's about 2 billion difference between where it was and where it should be by the end of the year, and then it kind of bounces back after that in 2024. That's probably a lot to do maybe with a lot of the equipment that was used for COVID, or testing things that was used to maybe they were making a lot of money from that, and that has now declined. I'm not sure what the reasons are, but there is a tiny bit of decline there. And then if we look at the EPS, okay, almost exactly the same. So the actual was $23, and right now we're looking at about 21 moving forward, and then 22 from basically bouncing back. So that's one of the companies. That's the 5 companies I wanted to talk about today. They are all Sharia compliant companies, okay. And as you can see here, you can pause the video and have a look at it, but there's no issues. Thermo Fisher probably has the highest interest-bearing debt, but the rest of them are absolutely fine. What I would do if I were you, if you're interested in any of these companies, do your own research, find out a bit more information, dig deeper, okay, before you actually invest in any of these companies. This is all just for entertainment purposes. Please always do your research. And like I said to you guys, I own 3 out of the 4, and I will show you very quickly before we move on. Okay, Hershey, I've got 10 shares of Hershey, 2 shares of Intuit, and ASML, I've got 8 shares of ASML, which is probably one of my biggest holdings, I think. As you can see, that's my 5th biggest holdings in this portfolio. Anyway, I'm going to stop the video here. Have a wonderful day. Assalamu Alaikum.